Okay, let's wrap this up. Chapter 1 Test Review, question 19 is based on the following. What is an asset? An asset has two characteristics. First, it's a resource owned by the company. It's something that can actually use. And secondly, an asset has future value. That is, it'll last longer than just a few minutes. It's something that has some life to it. And if it doesn't have those two things, it's not an asset. Now, number 19, how would the accounting equation of Boston Company be affected by the paying of cash in advance to an attorney $10,000 for legal work to be completed in the future? Alright, now this is going to be the accounting equation of Boston Company, right? And they're paying this money to an attorney. So what happens is they're going to reduce their cash by $10,000 and they're going to increase something called prepaid legal expenses, which is an asset also. Anything that's prepaid means that you have paid for something that you expect to get some use of it out of the future. Now, if this was legal services that had already been provided, if they'd already been performed, then you would reduce cash $10,000 and also reduce owner's equity by $10,000 under legal expenses. But this is not something that has been used up already. This is something that has future value. It's an asset. Alright, and then there's a little bit of my humor. And the last question on the review, question number 20, is based on the following. How do transactions affect the accounting equation? So, we have this company, Zion Company has assets of $600,000, right? Liabilities of $250 and equity of $350. Zion returns office equipment purchased on credit. What would be the effect of this transaction on assets, liabilities, owner's equity? If they return equipment that was originally bought on credit and hadn't been paid for yet, here's what happens. Well, I guess we want to know how would assets be affected, how would liabilities be affected, how would owner's equity be affected, how would expenses be affected, and how would revenues also be affected. Let's see anything else, and how would net income be affected. Alright, well, if you return this equipment that you bought on credit for $75,000, assets would go down $75,000, liabilities would go down $75,000, and owner's equity wouldn't be affected at all. Let's see, how would expenses be affected? They wouldn't be affected at all because this only involves an asset and a liability. Revenues wouldn't be affected because there's no revenue involved in this. There's only an asset and a liability. And how would income be affected? It wouldn't be affected at all because there's only an asset and a liability. Now, this is the end of Chapter 1 Test Review.